Over the next few minutes, you'll get a clear, actionable understanding of cyber liability insurance for tech startups. You'll learn what the policy actually covers, why it's not a nice to have, but a strategic necessity, how to think about risk in a digital-first business, and what trends are shaping the future of cyber risk. If you're building something in tech, this is the framework that helps you translate fear of the unknown into a plan you can act on with confidence. Defining cyber liability insurance for tech startups. Cyber liability insurance is a specialized policy designed to protect tech startups from the financial fallout of cyber attacks and data breaches. It goes beyond moldable promises and vague assurances. It compensates for concrete costs that arise when data is stolen, corrupted, or held hostage. Think data recovery and restoration, legal fees, regulatory fines, notification costs, and the reputational toll that can follow a breach. For startups, where every customer relationship and investor impression matters, this coverage isn't optional. It's a risk management tool that helps you survive and recover quickly in a digital age where every byte is a potential target. Why tech startups need cyber liability insurance? Tech startups operate on a digital engine. Code repositories, customer data, cloud services, and supply chains that depend on software and networks. That dependence creates a paradox. The more value you create digitally, the more you attract attention from attackers. Startups are often high-value targets because of the potential for rapid growth and the perception that security controls may still be maturing. When a breach happens, the costs aren't limited to the breach itself. There are customer fallout, business interruption, remediation expenses, and the possibility of regulatory scrutiny. Cyber liability insurance provides a safety net that cushions those costs and lets you stay focused on growth and innovation, even when the worst happens. It's not just about paying for a breach. It's about preserving cash flow, maintaining customer trust, and ensuring you can continue delivering on your product roadmap. Key components of a cyber liability policy. A robust cyber liability policy includes several critical elements that work together to reduce the aftermath of an incident. First, incident response coverage covers the immediate costs of a breach, hiring forensic experts, incident responders, and the actions needed to contain and eradicate the threat. Second, liability coverage protects against third-party claims, customers or partners whose data was affected by the incident. Third, business interruption insurance compensates for lost income and extra expenses when your operations are disrupted. Beyond these core elements, many policies offer data restoration costs, forensic investigations, public relations support to manage reputational damage, and even coverage for extortion payments in cases of ransomware. Each component plays a role in a comprehensive risk management strategy, ensuring you're not paying out of pocket for crucial responses or long-tail consequences. Assessing cyber risk in tech ventures. Before you buy, you should assess your unique risk profile. This starts with identifying the nature and sensitivity of stored data. What's in your databases, what's in the cloud, and what's in transit. Next, map your software and hardware vulnerabilities. Where could attackers gain access? What could be exploited? And where are your weak links in the supply chain? Evaluate your cybersecurity measures today, how you monitor, patch, and respond, how you train employees, and how you enforce access controls. Don't forget third-party risk, vendors, cloud providers, and contractors who have access to your systems or data. A thorough assessment helps you tailor the policy to your actual exposure, not just a generic template. It also highlights where further security investments are necessary, so you're not paying for gaps you could have closed in-house. Legal and regulatory considerations. The regulatory landscape around data protection is dynamic and region-specific. In many regions, strict laws govern how you protect consumer data and how quickly you must report breaches. GDPR in the European Union, various state-level privacy laws, and sector-specific regulations create real compliance obligations and potential fines for non-compliance. Cyber liability insurance policies can cover some of the financial penalties and legal costs associated with regulatory issues, but they cannot substitute for robust compliance programs. Keeping up with changes in data protection laws, maintaining appropriate consent, and data handling practices, and aligning your risk management strategy with regulatory requirements are essential. The goal isn't just to avoid penalties, it's to build a culture and architecture where compliance and security are embedded in your product and workflow. How to choose the right policy for your startup. Choosing the right policy starts with a clear inventory of digital assets, proprietary technologies, and sensitive data. Consider the scope of coverage. Does it align with the data you store, the systems you rely on, and the third parties you work with? Look for policies that explicitly tailor coverage to the technology sector, and consider the insurer's track record in handling tech-related incidents, their claims process, and the speed of remediation. A broker who understands both cyber risk and tech operations can be invaluable in negotiating adequate limits and deductibles, ensuring you have appropriate coverage for incident response, data restoration, and regulatory defense. Equally important is transparency about exclusions. Know what isn't covered and how incident handling works in practice, so you're choosing a policy that fits your risk tolerance and business model. Cyber liability insurance versus traditional business insurance. Traditional business insurance tends to focus on physical assets, property, and general liability. It often falls short in covering the digital risks inherent to tech startups, data loss, regulatory fines tied to data handling, and reputational management in the wake of a breach. Cyber liability insurance, by contrast, is designed to address the financial and operational realities of cyber incidents, loss of data, notification expenses, legal costs, and even PR support to mitigate reputational damage. For startups whose operations, customer trust, and product delivery depend on digital systems, cyber liability insurance fills gaps that a standard policy simply cannot. It's not a replacement for traditional coverage, but a complementary layer that acknowledges the shift toward a data-driven economy. Best practices for cybersecurity and tech startups. Insurance can hedge risk, but robust cybersecurity practices reduce the likelihood of an incident in the first place. Start with people. Provide ongoing training on data protection, phishing awareness, and secure handling of sensitive information. Enforce strong access controls and multi-factor authentication across all systems. Keep software and antivirus up to date, and encrypt sensitive data both at rest and in transit. Develop and regularly update an incident response plan that everyone understands, and rehearse it so your team can respond quickly and coherently. Regular vulnerability scans and penetration testing help identify weak points before attackers do. Integrating these practices with your insurance coverage creates a resilient posture that lowers both the probability and impact of incidents. Future trends in cyber liability and emerging tech risks. The risk landscape is evolving with technology itself. The rise of IoT devices, increasingly sophisticated AI-driven threats, and the expanding role of blockchain introduce new dimensions to cyber risk. Insurers are adapting by offering coverage specifically for connected devices, AI-enabled attacks, and cloud-focused incidents. Remote work and cloud services continue to expand the attack surface, prompting more comprehensive coverage for data in transit and in third-party environments. Regulators are likely to tighten requirements, and policies will evolve to address new forms of data processing and emerging technologies. For startups, staying ahead means continuously reassessing cybersecurity posture and ensuring your policy evolves in tandem with your tech stack and operational realities. Conclusion: cyber liability insurance is a critical component of risk management for tech startups. It addresses the growing threats associated with digital operations by providing coverage that traditional policies often miss. From immediate incident response and legal defenses to long-tail reputational management and business interruption protection, the right policy can help you weather a breach without sacrificing growth. But insurance alone isn't enough. Pair it with disciplined risk assessment, regulatory awareness, and proactive cybersecurity practices to create a defense that's greater than the sum of its parts. If you're building in the digital realm, you're planting seeds in a field that's constantly shifting. The most resilient startups aren't the ones who avoid risk. They're the ones who plan for it, fund it, and practice it every day. In that mindset, cyber liability insurance becomes not just protection, but a strategic enabler of steady, sustained innovation in a data-driven world.